So we began IAS 16 yesterday, and we were able to do some things on the subject yesterday. Can you see my screen now?
Yes, sir.
Yeah, thank you very much. So let me quickly run through what we did yesterday. We began IAS 16 talking about property, plant, and equipment. We went on to defining what property, plant, and equipment is. Then we move on to talk about initial measurement, how we measure it, what are the things that make up the elements of cost. We try to do some workings, looking at some deferred payment for an item of PPE purchased. Let's you buy an item in January, you are paying for it in December. How much to recognize in the financial statement in respect of that item? We moved on to talking about exchange transactions. That is, to give up an asset to take another asset. How do you recognize the one you just take in financial statement? And at what amount do you recognize the one given? And we're going to talking about when we say an exchange transaction lacks commercial substance. That is, you give up, like for instance, a car to collect a plot of land, and then eventually we now say, how do we know if that exchange lacks commercial substance? It is when the future cash flows that will come from the exchange does not change. It does not change. That is, it doesn't change the future cash flow of the company. We now say that lacks exchange transaction. We say it lacks exchange transaction. So it lacks a commercial substance, So we go to talking about elements of cost. Elements of cost, the items that make up the cost, the financial statement. We listed them there. We went on to pick an example of the elements of cost. We talked about when a company constructs an asset itself, how do they value the asset in the financial statement? We moved on to talking about elements of the transactions that are not part of the elements of cost. We listed them there. Talked about subsequent expenditure on any item of PPE. If the expenditure improves the asset's life, how that must be capitalized. And if it's just a replacement part, how that is treated as repair, how that repair and maintenance is explained in the financial statement, how it is treated. Then we talked about major inspection. That is, you are doing a major inspection to an item of PPE, how that inspection should be treated, separated from the cost of the asset itself. Then we moved on to talking about measurement after initial recognition. There are two models for measuring items of PPE after the initial recognition. Talked about the cost model, the revaluation model, and how that those models are used to measure any item. Dorothy, I can see you are also here. You're welcome. You can hear me, you can just chat yes in the chat box so that I will know that you hear what I'm talking about. Dorothy, good morning. Yes, thank you. I can see your message. So we talked about how we do subsequent measurement of an item of PPE. That there are two models used in dealing with that issue. There are two models used in dealing with that issue. We have cost model. For cost model, there are two ways that the way we treat cost model is that we take historical cost less accumulated depreciation. Historical cost less accumulated depreciation. Some of the examples we took yesterday were on cost model, and I'll still take one or two this morning on how cost model is being used to measure subsequently the value of items of PPE. And also there is a revaluation model, which is a model that is used also to measure PPE subsequently after initial recognition, after initial purchase. So revaluation model also has its use and what are the ways how do we treat an item. I think some of the examples we treat this morning will be based on the revaluation model. Since cost model is popular, of course, I did some example of cost model yesterday, and we'll be doing some this morning, just like two this morning, and then we'll go on to treat the revaluation model. And now revaluation model is used, how to calculate revaluation model when it's used. So we talked about now depreciation. You know what depreciation is, we mentioned it yesterday, and what we call depreciable amount, the cost of an asset or other amounts substituted for cost less residual value. We talked about what the residual value is, we talked about what useful life is, we talked about what kind amount is. And then I picked an example of parts of an asset. When asset is in various parts, and those various parts have different, each of the parts has different useful lives, and the cost of each part is material to the value of the asset. How that those parts are depreciated uh, separately. How that the parts are depreciated separately. I think we treated that as example. We treated that as example 3 yesterday. How that the parts are. Okay, let me check the examples. Okay, no, the overhaul is the one we treated that way. I'm trying to check. Yes, example 4. That was what we treated as example 4 yesterday. So now that this example here, if you watch the video and you check the notes, I'll be putting the notes there today because we didn't complete the topic yesterday. That's why I didn't want to split the notes. So we go then to talking about depreciation is charged as an expense in the statement of profit or loss each year over the life of the asset, unless it relates to an asset being used to construct another asset. So, for instance, if we have a lorry that we bought for the purpose of constructing a building, that's the reason why we bought the lorry. When we are constructing the building, the depreciation charges on the lorry will be going to the cost of the building, not into the profit or loss for the period. And then in this case, the depreciation is capitalized as part of the cost of the assets. So we explained that yesterday. I've talked about when depreciation commences from the date that the asset is available for use. Even if the company has not started using the asset, from the date that that asset is available for use, depreciation charges commences on that item of PPE. Then we talked about cessation of depreciation. When does depreciation charges cease? Then we say depreciation ends at the earlier of when an asset is classified as held for sale. That is, you want to sell the asset, and when it is derecognized, whichever comes first. If it is derecognized, of course, you don't depreciate again. And the day you classify the asset as held for sale, that is, you now want to sell the asset no longer is qualified to be PPE. The asset will now be treated as an inventory. Don't worry, under IFRS 5, learning more about non-current asset held for sale and discontinued operation. Now we talk about depreciation does not cease when an asset becomes idle or withdrawn or retired from active use. No, continue to depreciate even when the company goes into there is strike action with the staff, they are not working. There is, let's say, a situation like COVID-19, there is lockdown, the companies are not operating. That does not stop depreciation charges from being considered. Then we went to land and building. Talked about land and building. How that if you buy a building, you must value the land separately from the building, and how that land does not depreciate. So no depreciation charges will charge the land, only the building computed for depreciation. So an example here we talked about Kenekwa, except we give an exception that except that the land it's a quarry site, of course. If it's a quarry site and there is an extraction going on, there's extraction going on the land will be depreciated. That's the condition under which, the only condition under which land is computed for depreciation purpose. So if a company is into quarry, they extract gravels, they extract sharp sand, so they have bought acres of land for the purpose of this extraction, of course, from the date of purchase and when the land is available for use, depreciation will be charged based on how many years the extraction will go on. Like this example you can see here, they say Okene Quarries has purchased a site from which they will extract gravel for sale to the construction industry. Say the site cost is 50 million naira. That's how much they bought the land. It is estimated that gravel will be extracted from the site over the next 20 years. The lands must be depreciated over 20 years. That's what we explain. So if we want to charge every year, say 50 million divided by 20, that's going to be the depreciation charge for the land. That is the only condition under which depreciation can be charged to land. That's the only condition under which depreciation can be charged to land. So we now finally say buildings normally have a limited life, therefore depreciable assets. Buildings have a limited life, and so they are depreciable assets. Buildings are depreciable assets. They depreciate. So we go on to talk about the review of useful life. Okay, this is the part I need to work on yesterday, which I think I gave this example. Let me check if it was treated. Initial estimate. Okay, yes, I think that was the last example I treated in class yesterday, talking about how that depreciation must be charged prospectively. How that depreciation charges, if there is a change in depreciation in the useful life of an asset, how that change must be applied prospectively. How the change must be applied prospectively. That's what I tried to give the illustration, take that illustration yesterday, how that the change must be applied prospectively. So we did this example also yesterday that initially they thought the machine would last for 10 years. After 3 years, depreciation had been charged. They went on to discover that the machine would not last for more than 8 years altogether. For the first 3 years of the machine, we explained that the first 3 years of the machine, in the example, we explained that the first 3 years of the machine, the first 3 years, I can see the example, the first 3 years, the depreciation will be charged on 6,000 naira. Subsequently, after the 3 years, the depreciation will now be charged based on the 5 years remaining. That was the last example we treated yesterday. That was the last example we treated yesterday. So what we shall be doing this morning is to go on from where we stopped yesterday. So we are going to the next slide, which is talking about also prospective application of change in accounting estimates. Prospective application of change in accounting estimates. That the machine, please, if you can see the screen presently, this thing I'm reading, just say yes. If you can see the screen, this information I'm reading now, that is a machine was purchased 3 years ago on 1 January year 2. It cost 150,000. Can you see that screen? You see that screen, which is the slide. Okay, thank you very much. So now a machine was purchased 3 years ago on 1st January year 2. It cost 150,000 naira and its expected life was 10 years with an expected residual value of 30,000. Due to technological changes, the estimated life of the asset was reassessed during year 5. The total useful life of the asset is now expected to be 7 years, and the machine is now considered to have no residual value. The financial year, the financial year of the entity ends on 31st December. What is the depreciation charge for the year ending 31st December year 5? Now, this is a change in accounting estimates. Yes, Mr. David, you said you have watched that standard. It's a standard on its own. And Dorothy also, I will encourage that you watch that standard IAS 8. The video is on this platform at your free time. So because you were not in class when we treated that topic, but at least if you watch the video is explicit enough. You'll be able to understand what we have treated. So we want to treat this also as an example of a change in accounting estimate, how that a review of the useful life of an asset is a change in accounting estimate. The example we had yesterday also is on the review of the useful life of the asset. So I'll quickly open the Excel sheet now, and then we do this work. Machine was purchased 3 years ago, 1st January year 2. It costs 150 and is expected useful life of 10 years with an expected residual value of this amount. And then later, due to technological changes, the estimated life of the asset was reassessed during year 5. Total useful life of the asset is now expected to be 7 years, and the machine is now considered to have no residual value. So I'm going to be using the same workbook we used yesterday, but let me open a new sheet. So a new sheet 2, and that will be example. This example 5, that will be example 6. Example 6. Example 6. Example 6. So that is it. That is the example we are treating now. Example we are treating now is example 6. So we will first compute depreciation on the basis of the number of years that was previously that the building was that the machine was considered to live, which was 10 years, and that is what we are going to be doing for the first 3 years. So in the first 3 years, what we are going to be doing is, okay, this one is still loading. I want that is acting up. Let me just give it a few seconds so that it will be fully load. So what we are going to be doing is that the first 3 years, we are going to be charging depreciation. Depreciation charges will be 150 minus 30,000, which is the residual value. So the depreciable amount will be 120. And that 120 will be divided by 10. So that each year we are going to be having 12,000 naira depreciation charges for the first 3 years. That is December 31st, year 2, December 31st, year 3, December 31st, year 4. Now, due to technological changes, the estimated life of the asset was reassessed during year 5. So year 2, year 3, year 4, there's going to be. So what I'm going to be doing now is I'm going to be having a subheading here also that says review of useful life of an asset treated as a change in accounting estimate. Treated as a change in accounting estimate. Treated as a change in accounting estimate. So that is what we want to do now. So what we are going to be doing now is to have let's have the Naira sign. The Naira sign. So first thing we're talking about cost of the asset. Cost of the asset according to this, the cost is 150,000. So 150,000. Then talk about the residual value of the asset. Residual value of the assets. That one is, according to this question, 30,000 naira. So 30,000 naira, we are going to make it a negative figure so that it helps us to know exactly what we are going to do with it. So what we are going to have now is the depreciable amount. depreciable amount. A depreciable amount based on this information we have, it's difference between these two. Difference between these two, which is 120,000. That's the depreciable amount. Depreciable amount is 120,000. 120,000. So once we arrive at that, we now talk about the useful life. The useful life of the asset as initially measured. The useful life of the asset initially, they said it is 10 years, 10 years, 10 years, 10 years. So what is going to be the depreciation charge will be for the first 3 years before the change occurs. Depreciation charge is going to be 12 years. Okay, it's 150,000. Sorry, I wrote 15. This 150 and 30,000. Sorry. So let me increase what I wrote here. It's 150,000, and here also we have 30,000. So it is 120,000. So depreciation per year. Depreciation per year. Depreciation per year is going to be the division of these two. That is 120 divided by 10. 120 divided by 10. So depreciation per year is 12,000. So we are going to be having the table prepared here. So the number of years, we say year 2, year 2, and then year 3, So year 2, year 3, year 4, 5, 6, 7, 8, 9. Okay, let's just have it like that first. So I do the Naira sign here. Naira sign also be put here. Do the Naira sign here. And then we are going to be treating this depreciation, how it should look alike in the financial statement. So the first year, which is year 2, the cost is 150,000, and then the depreciation, which is going to be accumulated depreciation now. Accumulated depreciation will be in the first year will be the 12,000 naira. 12,000 naira. Accumulated depreciation is 12,000 in the first year. So the carrying amount in the first year, carrying amount is going to be, the carrying amount will be the difference between these two, which is 138,000 naira. So in year 2, cost is going to be the same thing all through. Cost is going to be the same thing all through for the number of years that we are going to have it. Sorry. Let me say this hot age. So cost is going to be the same thing all through. So because we are using the historical cost, you will see how that will change when we begin to use revaluation method. It's important for us to know what it's like here. So here, the second year depreciation will just be depreciation in year 2, year 1, like times 2, because that's going to be what we are having. It's going to be 24,000, and so this one also will be the kind amount will be 126,000, and in year 3, we're going to be multiplying that also by 3. Accumulated depreciation for 3 years times 3, and that is going to be giving us 36,000. So the kind amount will be this amount. So we're now saying that they review the useful life of the assets in year 5, which is the year we are about to complete now. That's when the change happened. So the useful life was reviewed in year 5. Due to technological changes, the estimated life of the asset was reassessed during year 5. The total useful life of the asset is now expected to be 7 years, and the machine is now considered to have no residual value. No residual value. So what we are going to be doing now is that we'll be treating, this is the first information we had on the asset, which is the first information. Then we are going to be treating the second information we have. The second information we have will now give us information about, let me put the Naira sign here, Naira sign here, give us information about costs. Now, cost. Now, so what we are going to be doing here now, because there is a change, the carrying amount as at that day is what we are going to be using. Carrying amount as at carrying amount as at January 1, January year 5. That's it. Carrying amount as at 1st of January year 5. That's what we are going to be working on now. As at 1st of January year 5, the carrying amount. This is it. Because look at it. The closing balance in year 4 is going to be the carrying amount as at 1st January year 5. So we have it here, 114,000. That's the carrying amount as at 1 January year 5. So we're going to now be saying useful lives, henceforth, useful life. The useful life of the asset, henceforth, according to this question, it said they are the total useful life of the asset is now expected to be 7 years. The total useful life, that is the 3 years it has been used before, and then and subsequently was going to be okay. I think this is in excess of 1 year. So now remaining 4 years. That's what it means. We have done 3 years. Total is 7. So it's now remaining 4 years. So the useful life remaining. Let me put remaining there. Remaining. Useful life remaining according to this now is 4 years. It's 4 years. That's the years remaining. Out of 7 years, we have had 3 years depreciation done already. So the useful life will be 4 years. Therefore, depreciation per year henceforth, depreciation per year henceforth will now be based on that. That is 114 divided by 4. It's going to be depreciation charges henceforth. So what I'm going to be putting here henceforth is now going to be this amount of depreciation henceforth from year 5. Then depreciation charges from year 5 henceforth. So it's going to be 28,000. No residual value. That is going to be consistent over. So we are going to be having the accumulated depreciation, that is in this year, we're going to be having this plus this. So we're having this this. Yes, plus this. Yes. So that's it. It goes on like that. Then we have this again. Plus this. Goes on like that. Sorry. Minus this plus this. Then it goes on like that again. Do this one also. Minus this. This. So at the end of the year, so this becomes the, oh, sorry, accumulated depreciation here. Sorry, there's a mistake in that. The accumulated depreciation here will now be that we have this amount that we had before. We'll start from that place plus this. It must increase. We had accumulated depreciation before. This plus this. Sorry. This plus this. Here. This. That's depreciation per year will be increasing plus this. And then we have here this. So that at the end of the year, the asset will become zero, that is fully depreciated. That is how changes in accounting estimate are done. When the useful life of an asset is reviewed, from the year the review took place, that's when the new depreciation charges will begin, different from the previous depreciation charges per year. So that's all on this. That's all on this as far as the depreciation charges, the review of useful life is concerned. That's all about this. Let me also put this in the bracket so that we're able to see when you are studying it, that is example 6. So now we have depreciation method. You are familiar with this from your previous knowledge in accounting. We have straight line depreciation method where we talk about cost of assets less expected residual value divided by expected useful life. That's what we did here. That's what we did here. Cost of the asset minus residual value divided by the useful life of the asset. Then we have depreciation charge. That's what we call the straight line method of depreciation charge. Then we have the reducing balance method of depreciation. This method. In this case, we say the is equals to the carrying amount at the start times the fixed rate. The carrying amount at the start times the fixed rate. So what I want us to do now is just to take an example. We will use this previous example that we use for straight line method, at least for the first 3 years, to do the reducing balance method of depreciation, just in case we have forgotten. I know we have done all of those in the past, but in case we have forgotten, let's use that as example 7. Example 7. So we say we are talking about the reducing balance method. Put it under it, reducing balance method of depreciation. Reducing balance method of depreciation. Reducing balance method of depreciation. So for the reducing balance method of depreciation, I want to use the same example we had here. I want to use the same example at least for the first 3 years. So as it is now, we usually reducing balance uses rates. So let's assume that a depreciation rate of 20% is given. So let me put it there that depreciation rate is 20%. Depreciation rate is 20%. That's it. Let's just assume, use that assumption that they give us a depreciation rate that is 20%. And so what we are going to be working on now is how to compute the depreciation charges. So the first thing, as we have an arrow sign here, the first thing we'll be doing is to pick the cost of the asset in year 1. So let me put the years here. Years. So let's say this year 1 cost is how much? 150,000, and then residual value is 30,000. So that is now, this is for the residual value. Now let me explain to us for straight line method. Once you say cost minus residual value, you divide the rest by the number of years to know that the position is evenly given. But for this reducing balance method of depreciation, we are going, even though we are given the residual value, we are going to be charging our depreciation on the opening balance, which is the cost. So depreciation rate rate is what, according to what we assume, 20%. 20%. So the requirement is compute the depreciation charges for the years. So I'm going to be saying depreciation charges now. I want to put it here. Depreciation charges for the number of years. Depreciation charges. Let me put it somewhere. I want to do something. Depreciation charges. Depreciation charges. So for year one, we are going to be saying that cost, which is 150,000, multiplied by depreciation rate, which is 20%. That becomes the depreciation charge for year one. Okay, let me reorganize this so that we can have it just year one, year two, year three. Done. That's it. For year one, depreciation charges is cost times depreciation rate. For year two, depreciation charges will now be the carrying amount of this after year one. So this year one, this year two. Let me do year two here. Year two. Opening balance of this has changed. Year two. The opening balance has changed. Initially in year one, it was cost of 150,000, but in year two, we are going to be having the opening balance to be the cost of the depreciation minus the cost of the asset, minus depreciation for year one, which is accumulated depreciation. So that's 120. So if we are charging depreciation for year two, we just say this 120 also times the depreciation rate. That's how that is computed. That's it. We are going to be using just the opening balance of the asset value multiplied by the depreciation rate. So for year three, opening balance, so I can just say this is a balance brought forward. Balance B/F. Balance brought forward. So this one will be our year one, this year two, and for year three. For year three, we are going to be having the opening balance to be this 120 minus depreciation for year two. That's how this is charged for year two. That's the opening balance. So depreciation charges for year three will now be this 96, which is the opening balance, times the depreciation rate. That's how this is computed. That's how we'll be computing it like that, until the asset gets to the end of its useful life. We are going to be saying the opening value of the asset times depreciation rate. So in the first year, the opening balance is cost. In the second year, the opening balance will be the cost minus depreciation of the previous year. In the third year, the opening balance will be the cost. Second year, the opening balance will be the carrying amount times depreciation rate for the year, and for the year three also carrying amount times depreciation rate. So that is how this is done. So from this year two, we're going to be having it as carrying amount. We're going to be having it as carrying amount. The depreciation charges will now be based on that carrying amount, hence from year two. So carrying amount for year two, carrying amount for year three, like that until we reach the end of its useful life. That is how depreciation is computed when it is a reducing balance method of depreciation. That's how it is computed when it's a reducing balance, making it different from depreciation charges under what we call the historical cost model. That's where it is in the historical cost model we have accumulated depreciation. But on the reducing balance method, we just have depreciation for the year, the rate charged against the opening balance, which is a carrying amount for the year. That's about that. So we have formulas for arriving depreciation rate here. For instance, they give us questions, they give us the residual value, they give us the cost of the asset, they give us the number of the years that the asset will live, and we are supposed to calculate the depreciation rate. You use this formula. So let me see if we can get an example to do that. Let me see if we can get an example to do that. Just 1 minute. Just 1 minute. Let's see if we can get an example to actually treat that. We should be able to treat that in an example because the question might just ask us to calculate the depreciation rate for the asset. Depreciation rate for the assets. So just 1 minute. Let me get a question that can enable us to actually treat that. A question that can enable us to actually treat that. I want to click it from the questions that we have here. If you have any question based on what we've done, you can be using the chat. Just use the chat to let me know if there's anything you are not clear about what I have just explained now. Use the chat box to let us know so I can quickly attend to that now. Any question? If there's no question, you can still use the chat box to say no question for now. No question for now, so that we know that I will know that you can hear me anyway. Since I can't hear you because I muted your mic, the chat box will help me know that you can hear me. I want to pick an example that help us understand how we may need to compute depreciation rates in case they give it to us. How that we need to learn how to compute depreciation rates in case they give it to us. Just quickly look into that. Transaction, right? Okay. Are you there? I can't see your chat. Okay, no for now. Okay, Mr. Alice, please. Workings of example 6 is on FS calculation directly without calculation of P/L charges. Okay, can we also do that in the exam? If we are still going to go to the computation depending on what they ask you. FS is the financial statement, that is a balance sheet, statement of financial position. Yes, we are still going to be doing that. If they ask us, we are just doing the calculation. You are right by saying that we just did it, this example 6 and even 7. We just did it based on example 6. Sorry, we just did it based on the questions we have, just computing. If we want to do for this information here is for balance sheet. You are right. This is for balance sheet. If we want to do for profit or loss, only the depreciation charge for the year. Okay, let me look at that. Let me see a place to put that here. Let me put that somewhere here so that we get exactly what you are saying, right? So let's say we want to have a statement of profit or loss here. So we have the number of years also written. Number of years also put here, number of years here, and then we have depreciation charges. Depreciation charges. That's the only thing that will go to the statement of profit or loss, depreciation charges, and that's going to be the annual depreciation, which is going to be, for instance, is at first for the first 3 years. For the first 3 years, it's going to be this. From year 1 to year 4, it's going to be this 12,000, and then from year 5 to year 8, it's going to be 28,000. 28,000. That's it. And the figures, of course, will be in jacket. I need to let us know that the figures will be in jacket. Because it's going to be an expense that will be deducted. It's going to be an expense that will be deducted from the financial statement. So the figures will be in jacket. Like that. And then we can have it put in jacket. That's what that's going to be in the examination. If they ask us to show the financial statement, they ask us to show the financial statement extract, how the account will look like. And so let me take this one down below again so that there will be space between statement of financial position and the statement of profit. statement of profit or loss. So we have here a statement of financial position. Statement of financial position here from this place down. No, the requirement might just tell us you are required. Show the financial statement extract over the life of the asset. This balance sheet statement of financial position. Statement of financial position here. Statement of financial position here. And then up here is statement of profit or loss. Let me just put a line there. It's a statement of profit or loss. Statement of profit or loss. Statement of profit or loss. That's what it's going to be here. Statement of profit or loss. So statement of financial position down here, statement of profit or loss here, which will only show the depreciation charge. Sorry, what did I do here? This is supposed to be 28,000. 28,000 negative from year 5 to year 8. 28,000 negative. 28,000 negative from year 5 to year 8. It's supposed to be 28,000 negative. That's it. The first 3 years, 12,000. The second for the last 4 years, we're going to be having 28,480. That's about that. I hope that answers again. The example 7 is not yet clear to me. The residual value is not reflecting in the calculation. Yes. When we are working, this is not a typical example for residual for reducing balance method. That's why it is like that. When they are giving us a reducing balance method, the residual value will help us know when the asset should stop depreciating. The formula for reducing balance method here is that residual value reducing carrying amount times, you can see here is where residual value comes into play. But when you're using reducing balance method, you just charge depreciation on cost. You remove the depreciation charge from the opening value. You charge depreciation on the carrying amount like that. That is how that is done. That is how that is done. If you look at the formula for cost model, residual value is there. The other model also, which is I said cost model. Yes, for straight line method, residual value is there. And the other method is this depreciation by number of units. Depreciation by number of units. We'll see residual value there. But for reducing balance method, no attention is given to residual value here, except we are to derive the formula for depreciation charge. So residual value will be here. The depreciation rate is charged on on the carrying amount. But in case we have a question, okay, let's do this. Where is the question I used for this? This one that has residual value. Now, okay, for the residual value, if we are given a question like this for reducing balance, and we are to charge, they will give us the rate. If they tell us that the change charge is going to be for 5 years, okay, maybe I should just give us a question relating to this. If the change charge will be charged for 5 years, and they give us the rate for 5 years, the rate for 5 years definitely will be 20%. That's the rate for 5 years, will definitely be 20%. Now, we have cost, residual value, depreciation charges. Okay, let me just do another example for us down here. Reducing balance method. Reducing balance method. Reducing balance. Reducing balance method. Using balance method. Depreciation. And then this is it. So we have costs. We have costs. of an asset of 150,000 and we are given residual value of 30,000. They will give us what the useful life of the asset is. Remember, this question we are working on is not specifically designed for this matter. For instance, if they now said, okay, the useful life of the asset, useful life, let's say they say it is 5 years. Now, when they give us a question like this, that we have all the information we need regarding it, and they are not talking about review in the useful life of the asset, the depreciable amount will be computed just like this, and that rate will be used. The depreciable amount of 120,000 will be computed just like this, and that rate, depreciable amount, will be used, and that rate will be charged the 20%. The useful life is they will give us depreciation rate, depreciation rate. When they give us, let's say that it's 20%. So we are going to be charging this 20% on top of this amount. We're going to be charging. So, but by the time we get to the last year, the last life value of the asset, that's when we remove this residual value from whatever remains. So let's say, for instance, we have year 1 we charge, okay, year 2 120, year 3 96. We didn't do year 4. Okay, let me just do something about that. Year 4. For year 4, we are charging the rate also on the carrying amount. The carrying amount is this. And depreciation charge, let me say depreciation charge is what? The depreciation charge. Here we have, for year 2, we have this amount of depreciation. Just coming and working on it. Year 3, we have this amount of depreciation equals minus this. And so year 4, we are going to be deducting, for the kind amount, we deduct the depreciation from, plus this. We have, that's the kind amount. We charge the depreciation rate on it also, which is this amount times the 20%. That's the depreciation rate. You can see that also in negative. And so we have the kind amount, which is at the beginning of year 5. Year 5 to now be this amount plus this. We have that. So we will charge this depreciation rate until, okay, this how many years? Now we don't have the number of years equivalence to this here. Year 6. For year 5, the depreciation charge will be this amount times 20%. Depreciation charge is going down, and we have this done, this amount, this minus this, the kind amount. Now let's chart the depreciation on this again. This times 20%. We have this amount. You can now see that the value of the asset has dropped. This in the number of years, because I didn't pick a specific question for this. I think what I will do is to make sure I have a question that will give us all the information, because one thing about the question is that they usually weave the information that will make your computation to be exact in the question. So as at year 6, at the end of year 6, which is how many years after the beginning of a charge? 1, 2, 3, 4, 5, 6. Okay, this is the first year. 1, 2, 3, 4, 5. At the end of year 5, you have 39,000. What is going to happen in that year 6 if computation is done that? We just make sure that the division charge will not be using the rate again. This 9,300 will just be the depreciation for that year. Depreciation charge for that year. If you leave the rate, let me see what it will give us. Now the rate, it will still remain something. So we will write everything up. They have told us that it has 6 years useful life and that the residual value will be 30,000. The point at which you know that the kind amount is equivalent to the residual value is where depreciation charges stops. That's where the charges stops if we are using the reducing balance method. Oh, we are not seeing the screen. Oh, okay. I think I knew what I was responsible for. It's just 1 minute. What was responsible for it? Can you see the screen now? Can you see the screen now? Please, can you see the screen? Can you see the screen now? Okay, yes. Dorothy, can you see it now? Sorry, didn't know you weren't seeing the screen. I showed the exact screen. So that is it. Look at it. Year 2, year 3, year 4, year 5, year 6. We are charging depreciation on each year. Reducing balance. What I will do is, okay, I will bring up a question that has all the information, because the question for straight line sometimes might have some technical information that will make it. So, but when we are given residual value and we are given the number of years, the terminal year, the depreciation may not be as accurate as the previous year. We will just make sure that we depreciate the asset to the point that what remains is equivalent to the residual value of that asset. Like if we do this now, the residual value of this asset after this year is 31,000. So if we say this asset has 1, 2, 3, 4, 5, 6 years, it means we will store depreciation here, and the depreciation that this charges here will be equivalent to 9,322. So that the residual value at the end of the day will be 30,000. So, but because this question is not specifically designed for this method, that's why we didn't treat it like that from the beginning. Don't worry, I think I will look for an example that will further explain how that we do that. Because if we are given the reducing balance, but one thing about ICANN examination is reducing balance is not usually what they are even expecting that you do. The complex application of this transaction. That's why in their study part, which I am using to tutor you, the reducing balance method of depreciation was not even used. But maybe I will try and get an example. Even in their past questions for FR and CR, they are no longer testing that. I think the last time they tested this, maybe when you were in school and maybe at the ATS level, they actually use straight line method, which is the commonly used depreciation method in practice. That is it, commonly used depreciation method in practice. Okay, because of our time, I want us to quickly go into this is just a derivation of residual value formula if we are asked to do that, but I'm not sure that is likely. Don't worry, maybe I'll just look for a day, look for some past question. If I can find anyone relating to residual value, sorry, reducing balance or some of the units or this quantity produced by an item. These are all depreciation method that can be used. So we'll talk about a change in depreciation method is a change in accounting estimate. For instance, you are using straight line. Also, you now want to start using reducing balance. It's going to be a change in accounting estimate. A change in accounting estimate. Can I give you a task to work? Let me hear from you. Let me hear from you. Let me hear from you. Can I give you a task to work on this new example? On this new example, so that it becomes engaging. Let me see your response in the chat. Can I give you a task to work on this new example? Can you work on this new example? Can you work on this new example yourself? That is, your fabric owns machine which originally cost 30,000 and it has no residual value. It was being depreciated by a useful life for 10 years on straight line basis. You can do the depreciation, but at the end of year 6, so you do for year 3, 4, year 5, that's 3 years. But at the end of year 6, when preparing the financial statement for 20x6, or your family decide to change the depreciation method from straight line to reducing balance using a rate of 25%. So for the first 3 years of this asset, it will be depreciated on a straight line basis, and the subsequent years, which is of the asset, it will be depreciated at the rate of 25%. Can you possibly work on this, or I should give it to you as an assignment? I'm not seeing your responses in the chat. Hello, are you there? Okay, that is typing. Okay, so all right, as assignment. Okay, I should give you as an assignment. Okay, so what I will do is to cut it out. I'll cut it out and then I'll post it so that you know it's an assignment. Let me just quickly do that. I'll cut it out and I'll post it so that you can treat it on your own as an assignment. So what I'll first do is to say assignment. Okay, I call the example here, but it's going to be an assignment. So let me quickly do that. So that I'll post it there in the group chat now. As assignment. So that you can use that to also practice on depreciation. Just 1 minute. 1 minute. Trying to post the assignment. I'll post the assignment for notice. Assignment. So that I want you to practice it to see if you understand the difference between. So I've sent it to the chat so that you can access it to treat it. So let me move on to the revaluation of property, plant, and equipment. Revaluation of property, plant, and equipment. If you are seeing, you can just give a thumbs up. If you can see the assignment, just click on it, give a thumbs up. Just give a thumbs up that you have seen the assignment in the chat. Have you seen the assignment in the chat? Send, okay. So you can pick it from there and work on the assignment. So let's go on. Evaluation of property, plant, and equipment. An item of property, plant, and equipment is recognized cost when it is first acquired, of course. IAS 16 allows a business to choose one of two measurement models as its accounting policy for property, plant, and equipment after acquisition. So the same model should be applied to all assets in the same class. What we are saying is you want to use revaluation method, whatever, or you want to use cost model, whatever method you want to use, you must make sure that it is the same for the same class of assets. You have motor vehicles, you have buildings, you have machineries. You cannot be using evaluation method for some machinery and using cost model method for evaluation model for machineries. For some machinery, I'm using cost model for some machinery as well. When they all belong to the same class of account, the same class of asset, you cannot use different depreciation method for them. For different evaluation method, that is the model, cost model and revaluation model. But if you can decide to use revaluation model for a class of asset and then use cost model for another class of asset. That's what I said. So two measurement model for property, plant, and equipment acquisition. We have the cost model, we have seen that before, which is cost less accumulated depreciation, and revaluation model, which is revalue amount less accumulated depreciation since the most recent revaluation. For example, a company's policy might be to value all its motor vehicle at cost, or to apply the revaluation model to all its lands and building. So that's important. When I say accounting for revaluation, when a non-current asset is revalued, its carrying amount in the statement of financial position is adjusted from carrying amount to its fair value, normally current market value at the date of revaluation. So I want to treat this example of revaluation model. The ones we've been doing so far is on cost model. That is, we know the cost of the asset, we charge depreciation, and then we use cost minus accumulated depreciation, and then we have what we call the carrying amount. But for this revaluation model, the method of charging is different. The methods of charging this depreciation is different. So that's what we are going to be learning now. This example on upward revaluation and downward revaluation. So let's say this example upward valuation. Say land was purchased for 100 on the first day of 20x6. Okay, maybe 100 million, yes. 20x accounting period, the business revalues its land as permitted by the IAS 16. The land was revalued at 130 at the end of the first year of ownership. So we are to see how this treatment should be done. So let me have it as example 8. Example 8 here. Example 8 here. Example 8. So it's going to be revaluation of asset. Revaluation of asset. Revaluation of asset. Revaluation of assets. Revaluation of assets. So we want to say the land was purchased, so at cost. Cost of the land. Cost of land was 100 million naira. 100 million. So let me round this to the nearest million so that we know exactly what we are doing. So 100 million. That's how much they bought the land when they bought it initially. That's the screen. Yes. Let me share the entire screen. So we want to do the example here. So this is the land. Example 8, revaluation model, cost of land 100 million. That is when it was initially purchased in 20x6. So let me put the year there, 20x6. 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 20. So they bought the land at cost for this amount of money. But they now said in what year? They said the business revalues land as permitted by IS 16. The land was revalued to 130 at the end of the first year. So the opening balance as 20x6, which is this amount. But at the end of the year, that is the closing balance, opening balance, then closing balance, which is same as balance of forward. They said the land is now 130,000 at the end of the year. So what has happened between this place and this place? What has happened? The land has increased. How do we treat that increase? That increase is usually called revaluation surplus. Revaluation surplus. Revaluation surplus. And that revaluation surplus is the difference between the closing and the opening, which is what? 130 minus 100. And then we have it there. Coming. 130 minus 100. We have it there as 30,000. That is the revaluation surplus on the land. Now, how do we treat this revaluation surplus in the financial statement? How do we treat this revaluation surplus in the financial statement? Very, very important. When there is a surplus and increase in the value of asset, it is usually treated under the statement of other comprehensive income. You will recall that the statement of profit or loss is also a statement of other comprehensive income. We usually call it statement of profit or loss, statement of profit or loss. Okay, let me use my capital letter. Statement of profit or loss and other comprehensive income. This is usually the name for these accounts. This is the name for the account. Statement of profit or loss and other comprehensive income is its original name. Now, what happens is that there is a section for profit or loss in this account, and there's a section for other comprehensive income. Usually, when we are doing it, because I'm still going to teach you the presentation of financial statement, how that you should, because in exam you'll be asked to prepare a financial statement. So you prepare yourself for that. So that the first segment is the profit or loss. Let me put that P or L there. P or L. The second segment is usually like this. This one has its own information here, but the second segment is usually other comprehensive income. Other comprehensive income, or we call it OCI. That is other comprehensive income. I'm picking the OCI from here. Other comprehensive income. It also has its own figure. And so when we have it like that, then what we're going to be having is total comprehensive income. That is total CI. Total CI will be here, which is going to be the addition of these two. The addition of these two is going to be the total comprehensive income. That is the formula. That is the format for this financial statement called the statement of income, profit or loss, or other comprehensive income. Now, revaluation surplus is treated under other comprehensive income. So we are going to be looking at the double entry for a revaluation surplus. How do we treat it when there's revaluation surplus? Double entry for revaluation surplus. Double entry for revaluation surplus. Double entry for revaluation surplus. How do we do it? Debit, then we have credit. Double entry for revaluation surplus. So when there's a revaluation surplus, the first transaction is to debit the property, which is the land, with the amount of surplus, which is what? 30 million. And then we are going to be crediting OCI, credit other comprehensive income, with the amount of the revaluation surplus. That's it. Debit land, which is the property, and credit other comprehensive income. The implication of this is that don't forget at the beginning, which is the opening balance, the cost of the land is 100 million, and that is what is in the financial statement. So when we debit you with 30,000, we are trying to increase its value to 130, and that excess of 30,000 is also taken to other comprehensive because it means in the financial statement this is where it's going to be. So I'm going to put it here now. I'll call it revaluation surplus, revaluation surplus. And what we are going to be having under this revaluation surplus is what? 30 million. This is where we are taking it. It comes under OCI. And so we are going to be having it 30 million as if this has no figure. So the two segments under the statement of profit and loss and other comprehensive income. The first segment is for profit and loss accounts, that is all the income and expenses that relates to the transaction. But when asset is revalued upward, it is treated under the other comprehensive income, that is OCI. That's why I call it OCI, other comprehensive income. That is where it is treated. That is where it is treated under other comprehensive income. Is where you treat revaluation surplus. Do you understand this? Do you understand this? I need you to use the chat board. Do you understand what I've just done? Treating the excess, please, requesting permission to leave for emergency. Check the video data. Okay, that's it. That's understandable. Take care. Actually, I don't want to drag it to 7 o'clock today. What I will do is usually this standard is usually the largest standard. The largest standard. Okay, thank you very much. Usually the largest standard. So what it will take a longer time. Like we can have 3 classes on IS 16, and because I must teach it thoroughly, there is no way you can escape questions on IS 16 in the examination. No way. There's no way. They usually test it every year because it is one major aspect of the standard that is very, 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 very technical. Even professionals who are already working have problem with this standard. So I can round up the class at 6:40. So if Dorothy can wait for 6 minutes, we'll close at 6:40. If not, you can watch the video. And then the next class, I'll make sure I complete the other part of it. Maybe then we have a larger house. So that's it. Mr. David said yes, it means you understood it. The revaluation surplus is treated as other comprehensive income. It's other comprehensive income, and it's like this. And the figure goes to this segment of the statement of profit and loss and other comprehensive income. That is where the transaction will be posted to. And later I'll be telling you, after leaving here, where else does it go? There are different financial statements. We have statement of profit and loss and other comprehensive income. We have the balance sheet. We have statement of changes in equity. That is where this figure will go eventually. So we'll be learning that on that. So when the valuation is reviewed downward, let me quickly do that before it is 6:40. This second example, we talk about upward evaluation. But when we say downward evaluation, land was purchased 100 million on the first day of 2026 accounting period. The business revalues the land as permitted by IS 16. The land was reviewed to 90 at the end of the first year of ownership. How do you treat it downward evaluation? So this is evaluation upward. And I have 8 upward evaluation. Upward evaluation. Then we are going to be having the next example, which is going to be example 9 on downward evaluation. Example 9. Downward revaluation. Downward revaluation for that example 9. So in this downward revaluation, we are still going to be having this information we have, which is what? The cost, So let me have this there. The cost and the cost of land is 100 million as given. But then at the end of the year, which is the closing balance, we say the cost is now, the value of the land is now 90 million. Definitely, there is something that has happened. The value of the land has gone down. The value of the land has gone down. And so what has happened is what is we call impairment. What has happened is what we call impairment, which is the difference between this amount of closing minus the amount of opening, usually in negative, which is what this amount minus the opening amount. And so we have negative figure because it reduces the balance. Negative figure because it reduces the balance. You can see there, that is it. But impairment is treated under the statement of profit or loss if it is happening for the first time. Treating impairment is done under the statement of profit or loss if it is happening for the first time. I will explain later what I mean by happening for the first time. So normally here we treat impairment here, impairment. Impairment of asset is treated as an expense during the period, so it's going to be in jacket. This is the amount here, 90. The amount is 10. Impairment is treated under the statement of profit or loss, while revaluation surplus is treated under the statement of order comprehensive when they happen for the first time. In the next class, I will now be telling us when something that has been reviewed upward is later reviewed downward, how to treat this. And the double entry for impairment, just like I did there, double entry for impairment. I'm closing at 7, just remaining 1 minute. Double entry for impairment. Double entry for impairment. How do we do that? So let's copy the credit and debit that we have there, the usual thing. So first is what we are going to debit the statement of profit or loss. Debit profit or loss, P or L. Debit P or L with the amount of the impairment, which is going to be in jacket. Debit P or L with the amount of impairment, which is 10. Debit it is going to be 10. Debit impairment, the double entry to debit impairment, and credit the asset, land, credit land with the same amount. That's the double entry for impairment. You can see double entry for revaluation when it's surplus is what? Debit the property, credit OCI. For double entry for impairment, debit profit or loss and credit land. That is the double entry for impairment of asset. So this example is related to impairment of asset. This example is related to the valuation of an asset. That's it. And so we have the statement here, how the two of them is posted to the statement, the financial statement. Impairment goes to profit or loss. Revaluation surplus goes to other comprehensive income. That is that. So do you have a question? This class is supposed to close now. What I will do is to make sure we complete it in the next class. It's always wide. There are other complications, and that one we need to treat it with diligence, and they are technical. Where questions are likely to come out, I hope to come with a past question that will bring those complications in the next class. So, do you have a question? If you are still here, no, Dorothy has left. So, okay, Mr. Michael, listen, you are here. Didn't notice when you joined. Mr. David, do you have a question? This is in the chat box. Do you have a question? No question. Thank you. Okay, Mr. Tosin, you just joined us. Of course, you're supposed to have plenty of questions. You can watch the video after the class. I'll put it in the chat. And so that assignment, Mr. David tried to work on it. You can put it in the group at any time. Finish it today. You can just proceed there. I will see it, and then I will respond as appropriate. You don't need to wait till the next class. Anytime you have chance, do it. Snap it with your phone. Put the picture here uh, on the platform, and I'll see it. So have a wonderful day. So I will update you during the day if I will attend to that class in the evening. But if not, then definitely we have it next week. And then I would have consolidated on the taxation class, taxation. Work on that, see how that will treat it. So have a wonderful day. See you in the next class, and I hope that by then uh, we have a larger house, and if you have any question, treat it then. So